Welcome to the Bipartisan Policy Center. My name is John Sarushian, and I am the Senior Associate Director for Business and Technology and lead our work on financial regulation here at BPC. Today, we're excited to host FDIC Vice Chairman Travis Hill for his first set of major public remarks on policy since starting his new role earlier this year. As many of you know, the FDIC was created during the Great Depression to provide deposit insurance for banks and is currently in the news a lot given recent turmoil in the banking sector. Vice Chairman Hill previously served as senior counsel at the United States Senate Committee on Banking, Housing, and Urban Affairs and was later deputy chairman for policy at the FDIC before being sworn into his new role. For today's event, Vice Chairman Hill will give public remarks, then be joined by Victoria Guida, an economics reporter from Politico, for a Q&A section. We will be taking questions at this event, but due to the volume of people here, we ask people write their questions down on the note cards that are at your seats, and someone from BPC staff will later collect them and hand them to Victoria for the Q&A portion of this event. After the Vice Chairman's remarks in the Q&A portion, we will have an expert panel to sort of discuss some of the issues brought up at this event, and that will be moderated by myself. With that, I want to welcome Vice Chairman Travis Hill, and thank you for coming to BPC.
They say that central banks raise rates until something breaks, and that monetary policy works less like a scalpel and more like a sledgehammer. It's been a common story over the past century. For example, recently in 2006, when the U.S. housing bubble popped after 17 consecutive rate increases. Each time, what breaks is a little different from the last time, but often with echoes of the past. The problems are never solely a result of rising rates, but monetary tightening puts pressure on the whole system. As the tide goes out and the punch bowl gets pulled away, margin of error shrinks across the board. Following the 2008 financial crisis, rates stayed at or near zero for the better part of 15 years, an extended period of easy money policy that culminated with the extraordinary fiscal and monetary stimulus of 2020 and 2021. As a direct result, over that 2-year period, the banking industry grew dramatically. While rapid growth by individual banks is often considered a sign of risk, in this case, the entire industry grew rapidly as America found itself awash in cash and the industry found itself awash in deposits. In 2022 and 2023, the bill finally came due in the form of high inflation, and the Fed swung its sledgehammer in the form of higher rates and quantitative tightening. In response, asset values fell and bank deposits began to shrink across the system. While many banks had kept an eye on their interest rate risk and asset liability management, Silicon Valley Bank did not. When SVB belatedly tried to address its problems in early March by selling securities at a loss and raising capital to fill the hole, its depositors lost confidence and stampeded for the exits. Less than 24 hours later, the bank was no longer the property of its shareholders and was instead in the hands of the FDIC. Mismanagement of interest rate risk was at the core of SVB's problem. Silvergate Bank, which announced plans to wind down and self-liquidate the day before SVB's run began, experienced the same issue. Both banks invested more than half of their assets in long-dated, fixed-rate U.S. Treasuries and agency securities. And of these investments, 79% of SVB securities and 73% of Silvergate's had a maturity of 10 years or more. As rates rose, the value of these bonds declined, ultimately, at least in the case of SVB, wiping out the tangible equity of the bank. Bank regulators have historically addressed interest rate risk through the supervisory process. For example, interagency guidance on interest rate risk issued in 2010 and follow-up FAQs in 2012 made clear that regulators expect all banks to be prepared for large interest rate increases following a period of zero rates. Beyond supervision, one much discussed way to address this problem would be to require banks to hold capital against some or all unrealized losses on their bond investments. It is possible that moving aggressively in this direction would have reduced the likelihood of SVB's failure as it may have forced the bank to address its core problems sooner, either by raising more capital or by reducing the maturity of its assets. But these types of proposals also have well-known downsides, including, for example, first, the tendency for market prices to exaggerate fluctuations in value during times of stress, and second, the incongruence of banks' capital requirements being driven by changes in the market value of securities while ignoring changes in the value of loans. There are numerous potential ways to encourage banks to better manage interest rate risk. We should evaluate any potential policy changes thoughtfully and, in trying to solve the problems of March 2023, remain mindful of how any policy changes impact the majority of banks in the majority of times. Of course, SVB was not the only bank to carry large unrealized losses on its securities portfolio. What differentiated SVB was the nature of its liabilities. Its deposits were almost all uninsured, highly concentrated, and, it turns out, remarkably quick to run. And once its depositors fled, we saw outflows at other institutions with similar profiles. Among those was Signature Bank, which also relied heavily on uninsured deposits and which was closed by the New York State Department of Financial Services 2 days after SVB failed. Industry-wide, the percentage of deposits that are uninsured has grown steadily since the early 1990s, from a low of 18% of domestic deposits in 1992 to a peak of 49% in 2021. Meanwhile, the total volume of deposits, both insured and uninsured, soared during the 2008 crisis and exploded in 2020. Uninsured deposits increased from $2.6 trillion in 2007 to almost $9 trillion in 2021, before declining to $8.2 trillion at the end of 2022. Generally, deposit insurance systems are designed to strike a balance between, on the one hand, reducing the risk of runs and providing people a safe place to put their money, with, on the other hand, promoting market discipline and limiting the socialization of the cost of failures. One of the core principles from the International Association of Deposit Insurers states, quote, "Coverage should be limited, credible, and cover the large majority of depositors, but leave a substantial amount of deposits exposed to market discipline," end quote. To the extent reforms are considered, I encourage policymakers to think through how the status quo and proposed reforms achieve their desired goals. For example, in the United States today, the deposit insurance cap is set not at $250,000 per depositor, but at $250,000 per depositor, per institution, per right and capacity, which means that the cap is $250,000 for some depositors and much, much higher for others, which might lead one to wonder whether those who would be most likely to impose market discipline are instead those most likely to ensure that all their funds are insured. Returning to Silicon Valley Bank, we have a simple story. The bank took a big gamble on interest rates and lost, and its uninsured depositors panicked. And once the run started, it accelerated much faster than anything the U.S. banking sector had seen before. Historically, bank runs have often, though not always, been fast. People tend to move with urgency if they think their money is at risk. In the old days, before computers and smartphones, depositors had to travel to the bank and wait in line to get their money out, and banks deployed various strategies to slow a run and restore confidence, sometimes successfully and sometimes not. As the years passed and technology and communications improved, the nature of bank runs evolved too. In the 1980s, the two largest bank failures were Continental Illinois and First Republic Bank of Dallas. In May 1984, Continental Illinois was the victim of what the FDIC described as a, quote, high-speed electronic bank run, end quote. Similar to SVB and Signature, more than 90% of its deposits were uninsured. The run lasted for 8 days until federal regulators broke the run by announcing that the FDIC would provide assistance. 4 years later, First Republic Bank of Dallas experienced a similar electronic run in which corporate depositors, primarily small Texas banks, withdrew $1 billion in a single morning. Then FDIC Chairman Bill Seaman described it as, quote, a real bank run, even if dressed up in high-tech garb, end quote. 2 decades later, Washington Mutual experienced 2 silent deposit runs, the first after the failure of after the failure of IndyMac in July 2008, and a second that took off after the September failure of Lehman Brothers. Rather than stand in line at branches, retail customers used ATMs and the internet to withdraw funds. At its peak, WAMU lost $2.8 billion in deposits in a single day, a massive figure 3 times larger than the total withdrawals over the 11-day run at IndyMac, yet 15 times smaller than the $42 billion pulled from SVB in one day, and 6 times smaller than the amount withdrawn from Signature Bank the following day. Game's the same, just got more fierce. On the morning of Thursday, March 9th, SVB looked to most like it still had a long life to live, but by that night, the question was whether the bank would be shut down Friday morning or Friday evening. From SVB's perspective, the supersonic speed of the run probably did not matter much. Whether the run took 6 hours or 6 days, once confidence was lost, it was gone. But from the FDIC's perspective as the resolution authority, the speed mattered a great deal. Once the SVB Bridge Bank opened on Monday, March 13th, the value of the franchise deteriorated rapidly as depositors withdrew funds and customers moved their banking relationships elsewhere. This underscores a critical lesson for regional bank resolutions. Once the bank fails, the government must be proactive in finding an acquirer as quickly as possible. The FDIC not only needs to be open to any and all bidders, it needs to act with urgency and initiative to solicit bids and make a deal happen. And for a bank like SVB, given the broader implications, this process requires the proactive engagement and leadership of other agencies, including the Treasury Department and Federal Reserve. The SVB failure also reinforces the importance of a bank's capability to quickly populate a data room so that potential bidders can perform due diligence. One obstacle to a quick sale of SVB was the time it took to meaningfully stand up such a platform. The FDIC's 2021 policy statement related to IDI resolution planning and subsequent FAQs discussed the data room concept, and capabilities testing around this seems a worthwhile area of focus going forward. Alternatively, the FDIC could achieve this goal through more innovative financial reporting. In 2020, the FDIC initiated a rapid phase prototyping competition to develop technologies to provide the FDIC with more granular and frequent data from banks that chose to participate. This type of tool not only could help expedite populating a data room for a failed bank, it also would give the FDIC access to much higher quality data to monitor broader trends, such as deposit flows in times of stress. Unfortunately, this project was discontinued. Another key capability is a firm's ability upon failure to immediately produce a list of key employees for the FDIC and to ensure those employees remain in their positions post-failure. This is critical both to continue operations in a bridge bank scenario and to facilitate marketing to and due diligence by potential acquirers. Even the most robust resolution plan is never going to be able to answer all the unexpected questions and issues that arise once a bank fails, so the ability to immediately identify, engage with, and retain key employees is essential. On the other hand, I tend to be skeptical of requiring, as part of resolution planning, detailed descriptions of hypothetical failure scenarios that are extremely unlikely to happen and extensive proposals for how the bank will be resolved. How a regional bank is ultimately resolved and sold will be determined not by the failed bank during peacetime, but by the FDIC and potential acquirers during resolution. And I suspect there are better ways to explore issues that might arise in different resolution scenarios than through detailed formal plans. Finally, the question of whether regional banks should issue long-term debt to absorb losses in resolution ahead of depositors and the DIF will warrant careful consideration in the months ahead. I've talked about the SVB failure, its causes, and a few lessons learned. Now I'm going to talk about something that is none of those things. In Washington, D.C., a town where people tend to criticize and blame first and learn and understand later, or never, there's been an effort to blame the SVB failure on S-2155, the bipartisan banking law passed in 2018. And so we have people searching under the couch cushions, under the carpets, under the mattress, in the storage closet, trying to find something somewhere to tie the SVB failure to that law and its implementing rules. I think it's quite obvious that S-2155 had nothing to do with it. The rule changes did not change the stringency of capital standards for a bank of SVB's size. The stress test did not test for rapidly rising rates. And the exact thing that got SVB in trouble, investing in government bonds, is the exact thing that the liquidity coverage ratio is designed to require. The reason for SVB's failure are quite straightforward and easy to explain, and those rule changes had nothing to do with them. When it comes to something like this, I encourage people to first look at the facts and then arrive at conclusions, rather than starting with the conclusion you hope to be true and grasping around for facts and support. And I urge policymakers to propose policy changes based on where we find evident holes in our framework, rather than just trying to undo policies of the past. Financial regulators are often accused of fighting the last war. Over the past couple years, a number of banks, under the watchful eyes of supervisors, traded credit risk, the problem of the last crisis, for interest rate risk, a problem of the previous crisis. We should closely review the lessons to be learned from the recent failures and be open to targeted changes to our framework, but we should be humble about what our rules and policies can accomplish and avoid the temptation to overcorrect. In a competitive, dynamic financial services industry with thousands or millions of independent actors, there will always be vulnerabilities, and in an era of aggressive Fed tightening, there will always be bigger pressures at play. Meanwhile, the FDIC continues to do its job as it has for the past 90 years. The FDIC staff deserves tremendous credit for their efforts over the past month, with many working through the night, night after night, and through the weekends, weekend after weekend. I'll conclude with my favorite quote from one of the stories on the recent banking turmoil. When the Wall Street Journal interviewed a customer who had just confirmed his bank deposit was fully insured, he told the newspaper, quote, "If you can't trust the FDIC, it's a banana republic," end quote. Thank you, everyone.
Thank you, Mr. Vice Chairman. With that, we're going to go to the moderated Q&A portion. I want to introduce also Victoria Guida. She's an economics reporter with Politico. And just quick housekeeping item, if you have any questions for Mr. Vice Chairman, please write them down on the note cards in front of you, and someone will come pick them up and hand them to Victoria. With that, I look forward to the Q&A. Thank you.
Thank you so much. Thank you, Vice Chairman, and thanks to all of you for being here. That was quite a meaty speech, and I think it sort of underscores the fact that you just took this job in January, and you've already had to deal with all of this in the last few months, and so a lot to talk about today. So I have my notes on my phone. I'm not distracted during this conversation, but I did want to start with that weekend specifically, and I was wondering if you could talk a little bit about the decision to invoke the systemic risk exception, which allowed you all to back uninsured depositors at SVB and Signature, and was that a tough decision? What kind of cinched it for you that was the path that you all needed to take?
Yeah, sure. To start with, it was definitely a very tough decision. I think it was a tough decision for most, if not all, that were involved. For me, the reason was solely a result of trying to stop what looked at the time like a very high likelihood of a wave of bank failures if nothing happened on Sunday evening. I know there's been a lot of focus on the uninsured depositors of Silicon Valley Bank and Signature Bank, and I think from my perspective, I think there's been something like 75 banks in the last 30 years that have failed, in which uninsured depositors have taken a loss. And I suspect that in every one of those bank failures, there are some really sad stories. The classic story is the person who has been saving up for years to buy a house, and they put all the money for the down payment in their account, and then the bank fails, and it's over the threshold. I think there are stories like that all the time, and so I think the sort of inequity between people in those bank failures taking a loss and people at Silicon Valley Bank and Signature Bank not taking a loss, I think that was one of the things that made it a very hard vote. But ultimately, that really wasn't what it was about. It really was about what we were facing come Monday morning if nothing happened. And I think the concept that you have SVB fail on Friday, Signature Bank fail on Sunday, stress at other institutions, I think that the notion that those two banks fail and then everything goes back to business as usual. I don't think that really was a plausible potential outcome. And so, I think there are lots of unknowns about how far it may have spread. But ultimately, as I said, it was really just about trying to stop what looked like a wave of bank failures.
Yeah, and what are your biggest lessons learned from that weekend? I mean, you talk a little bit about the need to find a buyer quickly. Is there anything that you would have done differently in hindsight, or that you think the agency should have done differently in hindsight?
Yeah, I mean, look, I think the big lesson in my mind is just that when you have this sort of thing and when you have the type of contagion risk, that the government just needs to be doing everything it can to try and find an acquirer and broker a deal. I think in this case, SVB was a unique institution, and there may have been obstacles, no matter what, to finding an acquirer in such a short timeline. But I still think a lesson for going forward is that people need to be reaching out to every potential acquirer, asking them, encouraging them to bid, finding out potential reasons why they might not bid, seeing if there are other things that can be done to encourage more bids. I think a big lesson is that those are the types of things that need to be done.
Yeah, and there was some noise from congressional Republicans on the Hill, as I'm sure you know, on this particular topic. I'm curious if you talked to them and kind of what you told them about this.
I think for the most part that weekend there was so much stuff going on that I was mostly focused on internal stuff at the FDIC.
All right, fair enough. So speaking of the Hill, there is a lot of debate about S2155, the law that rolled back some rules on regional banks. And you made very clear that you don't think that this had anything to do with what happened with SVB. But I am curious as to whether this situation makes you think that it's worth toughening rules on those medium-sized institutions, and whether some of the rules that apply to bigger banks would have helped in this situation.
I mean, I generally think that we should, as I sort of said in the speech, we should closely review what happened here. We should look very carefully at the role of the supervisors, the role of different rules, and whether there are targeted changes that would be appropriate. But I think generally, to the extent that there are holes, these are holes in the pre-existing regulatory framework. I don't think this is an issue of mid-sized banks not being subject to rules that large banks are subject to. It's, if anything, it's a question of, are we approaching things like interest rate risk the right way?
Yeah, and I'm curious how you see the role of supervision in this. Obviously this was a Fed-regulated bank, but just sort of generally, there's been a lot of soul searching about the role of supervision and how much falls on management versus how much falls on the supervisors. How do you think about that?
I think coming out of this, there will be a lot of deep reflection on how supervisors approach, how supervisors examine for things like interest rate risk and liquidity risk. Figuring out that right balance between, providing the proper level of oversight but not stepping into the shoes of bank managers. I think that's always one of the big challenges when figuring out supervision. But I would assume that will be one of the big things that comes out of this.
Yeah. No, definitely. And you also mentioned conversations about the deposit insurance cap, and I'm wondering if you could talk more about what you think policymakers should be thinking about there. I couldn't tell from your remarks. Do you think that we need more market discipline imposed through deposit insurance?
Yeah, I think the point that I was really trying to make is just that people should. I think people should scrutinize how the system works today and what kind of impacts different types of proposed reforms would have as they think through different types of reforms. I think when it comes to having limited deposit insurance, there are several reasons for that. One of those is market discipline. Another one is just sort of cost in general. But I think it probably is worth having sort of deeper, deeper levels of scrutiny of those types of things. One thing that's sort of related to that, which is not exactly what you asked, but sort of related, is this notion that, I've heard some people talk about the prospect of raising the cap, but if we raise the cap, we need to increase regulations along with it. And I assume the corollary to that is that if we were to reduce the cap, we should reduce regulations along with that. And I guess I think those types of notions deserve some scrutiny. The notion that less FDIC insurance should equate to less regulation would seem to sort of fly in the face of what happened last month. So I guess my overall point is just, I think people should think about how these things actually work in the real world as they think about potential reforms.
Yeah, well, and speaking of more or less regulation, I mean, you also touched on the fact that a key rule, the liquidity coverage ratio, actually incentivizes holding government bonds because they're considered safer. And so I'm wondering, how do you think in the wake of all of this, how regulators should think about these assets that are considered safe but have unrealized losses? How are you thinking about that going forward?
Yeah, I mean, I think that's going to be one of the big questions, going forward. Historically, that has been dealt with through the supervisory process and not really through rules. The question of whether this should stay as a supervisory issue or whether this should be factored into some of the rules, I think that'll be one of the big questions, I assume.
Yeah, and you're the one that has to answer it. Good luck with that. We do have a couple of questions here. There's a question about the federal home loan banks. What is your view of the fact that the federal home loan bank system, of the role that the federal home loan bank system played in the banking crisis? Are they the first firefighter on the scene, or do they encourage risk-taking by member banks that exacerbate the crisis, or both?
I'm reluctant to answer the latter question. I think on the first question, that answer is partly yes. I mean, I think it's typical that when banks come under stress, federal home loan banks and the discount window are sort of the two kind of lenders of last resort. And the issue is basically, do banks have, how much collateral do they have, and do they have enough collateral to pledge? I think as a long-term solution, that is an expensive way to fund things, or at least can be. I don't know. I know that there's a lot of people that are, that are investigating the role that federal home loan banks play more broadly in the system, and I guess I'd look forward to seeing what kind of conclusions people draw.
Yeah, and we have a couple of questions related to that first weekend. So why did the FDIC not announce the amount of the advanced dividend? And then here's a second question. I'll just give these two together. Given the unique investments that the bank and SVB had on its books, does FDIC have people with the skill set to evaluate the sale?
So in the first question, I think the reason is because there was uncertainty around what the advanced dividend would be. I think that there probably is a lesson learned there that clearer and more upfront communication probably would have been helpful. But I think that's probably something that deserves some further thought coming out of this. On the second question, the FDIC hires outside advisors, so the FDIC is not doing this totally on its own. And sort of as I said in the speech, I think relying on people from the institution, I think, is also pretty important in understanding what it is that you're selling.
Yeah, well, and I also have a question about, you touched on resolution planning in your speech, and I'm sort of wondering, given the way that this all played out, the fact that the failure of SVB sparked this panic, whether that should cause some kind of fundamental rethink about living wills and whether it's possible to have a much bigger bank fail and be orderly liquidated without causing contagion.
Yeah, I mean, I guess the way I look at it is, I think the way that Silicon Valley Bank failed was fairly unique. And I think the contagion was largely a result of the way it failed and the uniqueness of the institution. And so the contagion really spread to banks that had similar profiles, or at least were sufficiently similar to Silicon Valley Bank that, there was sort of a loss of confidence. And so I guess I'm a little reluctant to make conclusions that are too sweeping about other institutions based on that.
Got it. Okay, we have another question from the audience here. Is the FDIC considering using its broad authority to impose civil penalties or use any other regulatory mechanism to claw back executive compensation for these failed banks?
So the FDIC does investigations after every failed bank. My understanding is those investigations are still in the early stages, but I would assume the FDIC would go through its normal process and use whatever authorities it has.
Got it. Okay, we have, just to mix things up, we have a crypto question. What role do various cryptocurrency and DeFi instruments play, if any, in what happened or is likely to happen to prevent, what role do various cryptocurrencies and DeFi instruments play, if any, in what happened or is likely to happen to prevent negative impacts?
I think the answer is zero. I mean,
all right, fair enough. I know that was a question particularly around signature. There was some public statements, but fair enough. Also, I'd be remiss in not asking. What other risks do you see out there? There's been some talk of commercial real estate. What are you watching?
Yeah, look, I think I think there are lots of reasons to think that the banking industry is a lot more resilient than it's been, for example, in 2007, 2008. Capital is a lot higher, liquidity higher, things like that. But at the same time, there's lots of reasons to be wary. I mean, commercial real estate is the biggest thing that gets lots of attention. But I think from my perspective as the FDIC, we remain wary and vigilant, but at the same time want to see a stable and thriving banking sector.
Yeah, well, and you said a minute ago when you were talking about deposit insurance that it was worth thinking about whether lower deposit insurance would it would seem to go against the lessons of this crisis to say that lower deposit insurance should mean less regulation. I'm curious if you think, given that there's talk of strengthening a lot of these regulations, so you wouldn't be inclined to loosen any of these rules at all, right? Like, I guess that's sort of a broad-based question, but I guess what I'm saying is, do you feel like there's areas where rules are sort of too stringent?
I think there are always rules that are too stringent. I think that's the nature of bank regulation. But I think it's natural after you have an event like this to want to take a look at whether there are targeted reforms that could help prevent that sort of thing in the future.
Okay, let's see this one. The FDIC has put a lot of resources into resolution plans. SVB had a resolution plan. The FDIC reviewed it. What went wrong? And also, I'm wondering if you can sort of speak to, you had mentioned in your speech that maybe there are some aspects of living wills that you're not convinced are the right way to go, and I'm curious what you think an alternative approach would be.
Yeah, I mean, so I was really talking about the IDI plans for regional banks, which I think is really what we're talking about here. I think it's still helpful to have the plans, but to me, I think the focus should really be, what does the FDIC need to be able to sell the institution as quickly as possible? And it seems like two kind of takeaways here is being able to stand up a data room really quickly, which enables prospective acquirers to do their due diligence and better understand the institution. And potentially, the better they understand the institution, the hope would be the less of a discount from the FDIC they would need in a speedy acquisition. And just a reminder of how important it is to be able to rely on the key people at the institution. And so to me, and I think the IDI resolution planning process has been moving in this direction, but it's really, to me, the key thing is giving the FDIC the information that it's going to need, knowing that we're not going to be able to predict the actual failure scenario.
So was the not to put too fine a point on it, but was the resolution plan in this instance helpful?
I'm a little reluctant to answer that, but I think the answer to that is no. But that's maybe a little unfair to the process to be quite so definitive. I think there probably are aspects of IDI plans in general that are helpful to have.
Got it. Okay. Well, I think that is about all of the time that we have, but we now have a lovely panel that's going to discuss the Vice Chairman's remarks, moderated by John Sroujian. So thank you all very much. Thank you, Vice Chairman.
Thank you, Mr. Chairman and Victoria, for that insightful conversation. With that, I want to introduce our, can people hear me? Sorry. Okay, good. All right, with that, I want to introduce our expert panel who will be joining us. Let's give them a minute to take a seat. Okay. And sitting first to my far left is Karen Petru. She's a managing partner at Federal Financial Analytics. And next to her is Margaret or Meg Tyre. She's a partner at Davis Polk. Thank you both for joining us.
Happy to be here.
Great. So let's begin. So we have a sort of variety of people in the audience, some with a lot of expertise in financial regulation, some more relatively new. So let's first contextualize this speech and maybe some of the main highlights from the speech and any takeaways that you had. So do you want to start, Meg, first?
Sure. Very, very interesting speech. Obviously, the Vice Chair's first maiden speech, and what I find striking and helpful is he's not taking a narrow FDIC point of view, although the FDIC is his focus. He's really looking in a wide-ranging strategic way around history of runs and, overall regulation, including S2155. As someone who's done an enormous number of living wills, I was very interested, and I'll comment on that later, but let me turn it over to Karen for her reaction.
Oh, I agree. I thought it was a fantastic speech. I think Travis Hill will play a very important and constructive role on the FDIC. But it really reminded me how many questions we keep facing and unanswered issues from the last crisis. I wrote a note 2 weeks ago, and I said it was called Reflections on My Fourth Financial Crisis. And there might even be 5 because I started very early in my career, the S&L crisis, and you just keep seeing repeats. And I thought it was very helpful for Travis Hill to mention some of those. But also there were other issues in terms of thinking about resolutions. His focus on acquisitions struck me because one of the lessons of the last last 2 crises is the importance also of bridge bank and other resolutions options that don't involve acquisitions, so that we're even more careful not to enhance moral hazard. There's still a lot we have to think through because so many assumptions that became embedded after 2008 are being challenged.
Okay, let's start with resolutions, and since you both
Right.
highlighted resolutions and sort of living wills, so can you explain to the audience what exactly are resolutions and how do they work in practice, and what are some debates around what should be done with resolution authorities?
Sure, 2 different things. And since we're in regional banks, we'll stay in regional bank resolutions. So resolution is essentially the word for when the FDIC takes over as receiver a failed bank.
Excuse me, and I think it's important to differentiate here because we lose sight of this. Travis, because he's vice chairman of the FDIC, talked a lot about the insured depository institution. But Meg, we have the bank and we have the holding company. These are really important to remember that.
That's right, although Signature had no holding company.
Signature and First Republic don't, but a lot of others do. So
A lot of others do.
Okay, for the audience, can you explain the difference?
Sure.
Yeah.
And let's start with IDI, maybe receivership and resolution. Then we can talk about kind of the regional banks and SPOE, and then we can go to resolution planning. That's kind of probably the order. So the FDIC has, when it's a failed bank, right, and most banks, but not all, have a bank holding company on top of them, and the bank holding company is the top co and the public listed company that you're used to following the stock in. And then it has the bank underneath. For most regional banks, the bank is well north of 90% of revenues and assets. There are two different types of resolution plans. There's resolution plans that are under Dodd-Frank and which are required at the holdco and cover the whole organization. And the GSIBs have a whole different flavor that we should get into in some other time. And then regional banks have a different flavor of holdco, whole institution, Dodd-Frank plans, where the vice chair was speaking, and what was really coming into play in this particular crisis are the bank-only or insured depository institution plans, which focus on the FDIC's really special magic receivership powers under the FDIA. I'll stop and let you explain for a minute. I can take a breath.
No, these are, and the FDIC, in general, at the holding company level, and I just want to go back to that for a second because it's important, and even for regional banks. But the FDIC, when it looks like something's going belly up in the insured depository and the Fed for the holding company, the basic options are receivership, shut it down, conservatorship, which we can't forget because that's what Fannie and Freddie have been in since 2008. And the FDIC can do that too. Or a bridge institution in which it basically takes over, disposes of bits of the institution in various ways, and then essentially shuts it down in a longer-term manner. It's designed to permit, essentially, like a receivership, making the old failed bank disappear at cost to employees, to shareholders, to creditors, but without the chaos that an overnight receivership. The reason a holding company is really important, and even for the regional banks, but especially for larger banks and for the special purpose industrial loan company charters like a lot of Square and SoFi, is the holding company is now much more clearly required by law than it used to be a source of strength for the subsidiary insured depository. And the extent to which that is done and how it's done is one of the issues I think we're going to need to go back to.
And I think we're going to see that play out in the current bankruptcy.
Yeah, I do too. Yeah.
So we probably don't want to get too down in the weeds for a generalist audience here, but the way that the FDIC typically resolves banks is smaller banks. And think back to Doral, which was 2015, 2016. Doral Bank in Puerto Rico.
Yeah, even maybe a little earlier.
And that's an overnight P&A where one bank, in that case it was Banco Popular, acquired the assets and assumed the liabilities of Doral, and a couple of other bits and pieces went off to others. And so there was an announcement essentially at 5 o'clock on Friday night that it had happened, and at 5:02, only a slight exaggeration, it was, and here is the new acquirer. And that's what the FDIC in its normal way resolution tries to achieve. But, Silicon Valley Bank was about 20 times the size of Doral Bank. So Silicon Valley Bank and Signature were just much larger. So there was a use, once of the systemic risk exception of a bridge bank, except that bridge banks are super rare. They were, IndyMac aside, which is a special case, they really weren't used in 2008, and they haven't really been used for a major failure since the late 80s. There were the two bankers' banks in the early 2000s, but forget those. So there's a lot of learning from an actual bridge bank in operation, even though these bridge banks only lasted for about 10 days. Yeah. But bridge banks are difficult, as we have seen. So we may be getting too technical for this audience, but I think the key point on resolution planning, so let me move to that because Travis talked about that. There are these IDI, FDIC only at the bank level living wills and resolution plans. And these are not the Dodd-Frank ones. And we've all been working on them since 2012. I think it's worth saying that SVB had only filed one plan, so they had filed their first plan. And what you see as an institution does it is it gets better and better over time. And Travis's point, with which I agree, having seen many, many IDI living wills over the years now, is in the past there's probably been too much theory and not enough facts. In other words, there's been a lot of theory and hypothetical strategy about what might have caused the failure and what the numbers might want to look like. And when it comes down to the actual crisis, what you need are, who are the key employees? Where's the data room? What retention agreements do we need? Where do we have the information on the loans? Who's running the wire room? Who's doing this? What can we, and it's more granular facts, more of a cookbook on what the FDIC staff needs to get their hands on right away, and less theory, for me, is the lesson on the IDI plans out of this crisis.
I just want to say, in 2019, Marty Gruenberg gave a speech, and he said, we at the FDIC, we really don't know how to resolve a large regional bank. That was an important thing to know, and a good question 10 years after the great financial crisis, where WAMU was sold off in whole at great cost, both to financial market competition and implicitly to the FDIC. How come we still don't know how to do this? And I think a lot of it is weeds. We've been doing all these plans, and then you get back and say to the FDIC, where's the plan? Another important contribution from Dodd-Frank, Title II, the Orderly Liquidation Authority. I've written a bit about this, and I plan to do more. When you have you decide you have a systemic failure, why don't we use Title II so that we're not, again, bailing out institutions, but we have an orderly liquidation authority designed to ensure a systemic resolution as close to bankruptcy as possible? And the answer, why don't we use OLA, is because the FDIC doesn't know how to. By its own admission, 15 years after 2008, it still doesn't have a plan. And I think very much, in terms of where Congress goes with this, it's not just on the banks and which rules in 2155, and it's not on how to do it. I think new living wills and resolution planning improvements are vital, as Meg says, but we also have to have an agency that has thought some of the hard questions through on its own.
Yeah, I'm not convinced this would have been the right use for OLA in this particular one. But I do think that there are learnings from the Bridge Bank experience. There's testing of capabilities, not only in the private sector, but maybe we need operational capabilities testing for the FDIC staff, and bringing together a number of kind of on-the-ground, having been in both Bridge Banks, a number of on-the-ground learnings that will be helpful for the next crisis.
Okay, great. Wanting to get to a few more topics, a few other things I heard during the speech. Mr. Vice Chairman talked about interest rate risk, uninsured deposits, and the S21155 bill that later became law in 2018. Can we touch on some of these? And maybe we can start with the S12155. Can you guys tell us, we'll start with you, Karen, what exactly is in S2155? What were the debates around it, and what are the debates coming forward? So Travis gave his perspective. I know there are many people who disagree with him, and I'm trying to figure out, give the audience a sense of this law, what's in it, and what the debates around it are.
Sure, I'll be quick, because I know, Meg, you lived it too. The major initial point of 2155 was to repair something in Dodd-Frank where systemic institutions were defined as $50 billion and up. And $50 billion bank holding companies or banks are really small, generally very simple organizations, and all of the rules were very burdensome to them. So what the law says, okay, we're moving that 50 billion systemic threshold for enhanced regulation up to 100, and then we're going to do what the catchphrase is tailoring. we're going to give the agencies authority to set categories, 100 million to 250, 250 and larger, and then global systemically important banks, GSIBs, and ratchet the rules up so that the rules are tailored based on asset size and the agency's complexity, because asset size is a very dumb way to look at how risky a bank might prove. And the Fed, which led the way here, the other agencies concurred, not only eliminated the rules for 50, the enhanced rules for $50 to $100 billion, but they did go considerably farther than the law required and eased many of the capital and liquidity rules that had previously applied, particularly in the $250 to $700 billion range, and to a lesser degree, 100 to 250. Now, one of the things I've said a number of times, it's really important to remember that in each one of the rules, the tailoring rules, whether it was for U.S. or foreign banks, the agencies had what they called a reservation of authority. And it says, regardless of how much we've eased these rules, if we see any institution whose risk warrants enhanced supervision above and beyond that which they're nominally required to meet, we reserve the right to whack them. And I really think, while I agree that some of the aspects of the tailoring rules, not the law gave the Fed the jurisdiction, rules require a tune-up. The real issue is the agencies knew that they would need to do idiosyncratic regulation. And so saying this is an idiosyncratic failure doesn't tell us much about the rules, but tells us a lot about the supervisors and the Fed in particular's inability either to have good supervisors or listen to the ones it had.
And Meg, before I give you a chance to sort of build off of what Karen said, can you also talk about sort of the difference between supervision and regulation and responding to?
Sure, because I think it's an important distinction that Karen just made. The way to think about regulation and supervision is that regulation is the 10% top of the iceberg that you see floating above the water, and the 90% is supervision. So regulation, let's call it law and regulation, it's what's public. It's the laws, it's the regulatory framework, such as Karen just described, it's the public guidance, it's the supervisory letters, and that is the framework, the law and the guidance. Underneath that is what the examiners actually do in their back and forth, in their examinations and in their interactions. And that's really 90% of what goes on. So something that happens in the area of banking regulation and supervision is the academic commentary and most of the public commentary is based on the 10%, not the 90%. And I think, if you work with banks and if you work in there's something called confidential supervisory information, which consultants and lawyers get to see, but under very, very strict circumstances that we can never discuss it. And so you get this weird mismatch of what really happened and what the public commentators think happened. We're about to have a major shift in that, in the sense that when the FDIC and the Federal Reserve issue their reports on May 1st, because they take a different view vis-a-vis failed banks, we're going to get, really for the first time since I can remember, major chunks of a body of confidential supervisory information out there in the public. How much we're going to actually see or be able to understand and what the supervisors were doing is going to be an open question. Although I think those reports are just the beginning. There will be other independent reports and reviews.
Great, so we'll see that 90% that you're saying.
Right.
That should be interesting. Another issue that came up is the issues around deposit insurance and the uninsured deposits. Karen, I believe you've talked about deposit insurance reform in an op-ed recently. Mm-hmm. Can you give us a sort of flavor of just what are the debates around deposit insurance and reforms around them, and sort of what's in your plan? And Meg, I'll give you a chance to react after that.
Right, the fundamental issue in deposit insurance is whom do we protect? Who should get the benefit of a federal safety net? And one aspect of the debate that's going on now is banks and you have the smaller banks saying we should get unlimited deposit insurance because we're not risky and we're not big and we're not bad. And the other way to think about it, which I prefer, is to think about it from the depositor's perspective. And in my op-ed in Barron's a couple of weeks ago, I tried to think about who has the ability to judge the risk of a bank. Because the whole point, when the FDIC was created in 1933, Roosevelt actually opposed it as a New Deal reform. It wasn't one of his, because he said it will encourage risk-taking. And he finally agreed to the creation of the FDIC, partly because it was in the body of New Deal legislation he very badly wanted, but also because Congress agreed to a $2,500 cap, which in modern dollars is $58,000. So we need to think about whether 250 is enough. I think the down payment example is a good one. I saw this because I sit on the board of a biomedical foundation, and over the weekend of SVB, in between all the banking issues, on our foundation, we have a big venture philanthropy fund, and we have invested a lot of many millions of dollars in small startup biomeds. And Silicon Valley Bank had what it called exclusivity clauses, in which they required any venture capital firm they financed to hold the funds it received in SVB, and also that the VC require any entity it supported to hold the funds in deposits at Silicon Valley Bank. So all of a sudden, 5 of the companies in which we invested in had their payrolls locked up. And without payroll, they closed. So we've got to think about operational deposits. I think we have to think again about non-interest-bearing household deposits. And Travis Hill, I think, made an important point, how the role of these reciprocal deposit, where wealthy people can break all their money up into 250,000 pieces for a small fee, and innocent smaller companies have their payrolls at great risk. We've got to rewrite the equity value of who gets the subsidy and who doesn't.
Okay, before Meg, you get a chance to respond, I want to let the audience know we're going to go to Q&A after Meg's response. So if you have any questions, think them up. I will call on people. Just raise your hand after Meg makes her comments. With that, Meg, go ahead.
I think I completely agree with you on smaller companies. Just a couple of observations. We can't make the system so complex that it's operationally not feasible. We probably also don't want to be the only country in the world with unlimited deposit insurance. Mm-hmm. Where I am on deposit insurance is I know the FDIC is about to do this study. I know there's a lot I don't know. And I'm in a data first, policy second. There's a lot of ideas being whipped around right now. You know, can we do it for payroll? Can we do it for kind of, you know, those who can't necessarily do market discipline? And I just think it's too complex to decide and too important in a data vacuum. So what I think we ought to do is let's get data first. It's a complex topic. And then hopefully, because this has been an area where there's been unusual bipartisan consensus, we can actually have, you know, a grown-up discussion in Washington about ways and places that we need to go in deposit insurance.
I hope my op-ed is a grown-up discussion, Meg, and there's a good deal of research behind it. So, yeah, I hope we move quickly with the
I hope
data
we move quickly, but your proposals are at a kind of a higher level of generality than many that I have seen around at the moment.
It was a short op-ed.
It was a short op-ed.
There's more behind.
Constrain you. That's the thing. All right, let's go to Q&A. I believe the gentleman over there had a question. So let's wait for a microphone, though, and then please introduce yourselves. And do we have a microphone person? It's coming right there. Okay. And yeah, just introduce yourself and keep it brief if possible.
Yes. Dana Chasen, 2020 Vision. Thank you very much, both of you. With regard to deposit insurance, are all depositors alike? Are there some? No. Okay. So how do you distinguish, and what are the implications for protection thereof?
Okay.
Well, I would say depositors are no more alike than any of us. But there are broad categories of them. There are individuals. There are businesses that then have different kinds of deposits. There are interest-bearing and non-interest-bearing deposits, and then there are reciprocal and brokered deposits. And so I think we have good taxonomies of what the deposits are, well enough at least to try to make some initial calls about where the equity lies.
Some of the challenge here is what can the FDIC do on its own and what requires legislation. And to raise the 250 limit requires legislation. Another thing that would require legislation, and I think is an idea that's worth putting into the hopper, is to go back to what we had before Dodd-Frank. You know, right now for the systemic risk exception, the FDIC, if it wants to do what it did in 2009 and temporarily for a fee guarantee all, most non-interest bearing, but all virtually deposits for a limited period of time, has to get not only the triple keys of the systemic risk exception, 2/3 of the FDIC, 2/3 of the Fed board, Treasury Secretary in consultation with the president, but also a congressional resolution. And what we saw here is Congress was out of session when this happened. So that is an idea worth putting in the hopper, which would require congressional change, and which certainly in 2009 calmed the panic. But I really want to see a lot of analysis on, you know, do we do finely grained, you know, who are the deserving depositors and who are the undeserving depositors, and that, you know, I'm just not quite sure where that would go. So I'm myself, I'm kind of holding, I know this is, you know, we live in a world where people want to make an instant decision and it's a Twitter, you know, paced environment. I kind of want to hold fire until I have more data and then think through it.
Great. We have time for one more question. Gentleman in the back.
Hi, Vern McKinley. I'm a contractor for the IMF, the International Monetary Fund, the last 15 years. This is going to require some speculation, but what's your sense of the genesis of the idea of bailing out the uninsured depositors in, you know, that weekend in March? Chairman Bear, in the global financial crisis, describes in her book that she acquiesced to some of the bailouts, meaning that, you know, her position with the FDIC, she was hesitant to do it, but she was pressured by either Treasury or the Fed to do so. Do you think something parallel like that happened here, where the Treasury and or the Fed kind of put the finger on the FDIC and they ended up going along with the plan, although it had such enormous costs and the inequity issues that the vice chairman mentioned?
Karen, do you want to go first?
Sure. I think the reason why we had what in economics you call an Minsky moment, a shock. Because remember, I mentioned before 4 financial crises, and every one of those uninsured depositors were one way or the other rescued, unless they were at very small banks at the beginning or the end of the crises. So the expectation of rescue was embedded in the financial system. And what happened when SVB failed, and people didn't understand the difference between uninsured and insured deposits. And I've told this story a couple times. It's Sunday morning on that weekend. I happened to be having a manicure. And the manicurist, who knows me well, said, "Is my money safe at the bank?" And I said, "Do you have over $250,000? And she basically said, "I wouldn't be pushing your cuticles around if I did." Fair point. I kind of knew the answer. But she had planned to go the next morning and pull her money out of the bank and put it under the mattress because she was scared. And the problem, I think that, and having talked to some of the folks who made the decision since, is that the system was on fire, and they feared, and from judging by this conversation and some of the others I'd had over that weekend with regular people, they feared with reason that there would be panic across the banking system as people didn't understand whether their money was safe or unsafe.
So, kind of 3 observations. You know, I agree with Karen. If you look at the history of purchase and assumption agreements, you know, where another bank acquires, that's both insured and uninsured. So something like over 90% of uninsured depositors have been taken into the P&A by the new bank, so that expectation is there. Here's what I think made the difference over that weekend, because the FDIC had to make this least cost without the systemic risk, and that's why they went with the unusual structure. Over the weekend, it became increasingly clear, and we and most law firms, it was rolling half-hour calls. Payroll all over, not only just Silicon Valley, in Ohio and in other places, by small institutions was not going to be met. And so the idea that there would be this ripple effect throughout the economy, that small and medium-sized businesses would not make payroll, I think is what turned it around. And I don't think it was a forcing of the FDIC. I think it was a realization by the top of the house at the FDIC, the Fed, and the Treasury. Payroll, things like the biomedical example that Karen has that she knows about it, and I think that was repeated in a number of other sectors, including implications for national security, because many of those startups also are doing things there. I think that plus the contagion that the vice chair described for Monday morning is what turned it around. And I think this interaction of payroll and payroll processing is something that was a new realization in this crisis.
All right, thank you. With that, I'm going to wrap up this event. I want to thank our panelists for joining us for this very fascinating and helpful discussion. I also want to thank several people that made this event possible that are not on stage but have been very valuable. Andrew Nason, Aaron Mead, Hanadi Jordan, Emily Burns, Letty Nocera, and our vendors. So thank you guys. Finally, I want to thank everyone who joined us here in person or are watching us online, because without you guys, we just won't have events. And so thank you all, and I hope to see you guys next time.
Thank you.
Thank you.